可以了。Hey, James. Yeah, we're having some problem with uh, meeting, and I will give you a Zoom link. Can you log in the Zoom link from the Teams? Okay, yeah, I'll send you.
We can hear you now. Can you see something? Wait, yeah, don't stop the music. It's working now.
Okay. So it's working?
Yeah.
Okay. If you can hear me, that'd be great. Can you hear me? If you can hear me, that'd be great. Can you hear me? Okay, great. Hello, everyone. Sorry, we were doing some testing and as we made some changes with the system, and everything seems to be fine now. That's great. That's really great. And yeah, I already see some names. Helen, nice to see you again. And yeah, I think I missed you in the last few meetings, but glad to see you join again. And everyone else. Yeah, again, I'm Charlie Tian from GuruFocus. I'm located in Dallas, Texas. And Okay, I'm back. Sorry about it again. We had some technical problems. Now we're fine, and glad to see everyone again. And very glad here. And again, I'm in Texas, located in Plano, Texas, North Dallas area, and we actually the weather this year is pretty good. Is so far this year it has not been so hot, and we're having a good time, I think, and hopefully it will stay long enough. And I wonder that if you can hear me. It's yeah. Can you remove anything? Yeah, remove. Yeah. Well, okay. Now, okay, great. Great. That's great. Sorry about it. And okay. Now let's get started. And let me share my screen. Actually, this month I'm very excited to introduce some new features we have introduced. We have added lately. And now, if you come to any stocks, you will see that we have added a moat score and tariff score there. Let me share my screen with you so that it's you can see it. I can point you to where it is. And if you come to this, to see my screen here, you share it. And you can see my screen here. And if I type any stocks in here, I just type any stocks. Right, so I just come to any stocks. You should be able to see, okay, I type in Microsoft, and you should be able to see it, Microsoft. And if you come to the profitability rank box here, and come here, you can see that we have added two scores here. One is the moat score, and the other is the tariff score. We have actually we have been studying Warren Buffett for a long time, and if you read about Warren Buffett, he has always been saying that moat, the economic moat, is one of the uh, most important factors in his decision making, because he want to hold he want to hold the stock forever after he buys. So the company has to have wide economic moat that keeps its long-term competitive advantage. So moat is a factor, is a rank which measures the long-term competitive advantage of a company. So that's why it's extremely important. We have added a moat score in this case to help investors, to help us to decide the quality, the long-term investability of a company. So that's why we added a moat score. And in general, if you think of moat score, we do consider lots of factors. The factors such as, does a company have a leadership in certain area? Does company have a lower cost? Does a company have a like a IP or a patent, something which make it very hard for other companies to replace its product? So a lot of things. What is the switching cost, for example? So those are the factors we consider the to rank. We consider to rank the economic moat. And Warren Buffett liked Geico because Geico, he think it's a low cost producer among all insurance companies. That's why he liked Geico. And he liked Burlington's Northern Santa Fe because it's just impossible for others to build railroad anymore. And then for others, there can be switching cost. The high switching cost make it very hard for other companies to enter the area, like Moody's. No, I'm sorry, and not Moody. Moody has a wide economic moat, but it's not a switching cost. It's more like something else. And even a bank, we all use banks, and for banks, it's actually for if we get used to it, we link a lot of our payment to this bank. It's hard for us to switch to another bank. That's the switching cost. So then, in the case of Microsoft, for example, we do write the moat. What makes Microsoft wide moat here? It says Microsoft has a robust wide moat due to its dominant market position. Here, you can see this box here. Strong brand, extensive network effect. It benefits from high switching cost, valuable IP, and consistent innovation. So we do list the reasons here, and it's actually yeah, we think it's a very important factor here. And then we also add a tariff cost because tariff is a popular word this year. And we know that with a new administration, and there's lots of talks about tariffs. So that's why we add a tariff score here. A company with higher tariff score is less affected by the tariffs and has a higher tariff score. And we consider where the products are made, for example, the supply chain, whether it's really dependent on the global supply chains like that. And what kind of product does it make? If it's a software or service, maybe it has it's less impact by the tariff policies with the government. So that's why we added the tariff score. Let me see any questions here so that I can answer here. Okay. We are I wonder if okay. There's a yes. Actually, for the tariff score, we do consider we do use AI to help us with the ranking. Yes. And what's considered a good moat score? The moat score, both moat score and tariff score will help with AI for the ranking. And if you a good score, because the score is from 1 to 10. And so anything with 8 or above will be a good moat score for both tariff score and moat score. Also, our growth rank, our profitability rank, our financial strength, anything with an 8 or above is a high rank. Okay, again, for the okay, do we have sound? Can you hear me? Yes, I think you can hear me. Okay. If you cannot hear me, let me know. Yes. About tariff scores, if you want to repeat, we will actually add the definite links here to this here, explain the details, how it's ranked, what factors we consider. For tariff score, we do consider things like the supply chains, where the product's made. Those are the important things that that can be impacted by tariffs. Even Tesla, for example, 20%, maybe around 20% of their parts are made from not in the US, but in other countries. So they are affected by the tariffs. And let's go to Tesla, for example. What kind of scores we get? We can take a look here. And Tesla has a tariff score of 4, which is not good, because it means Tesla is more impacted by the tariffs. And let's check another company. For example, Ford. Ford is actually ranked slightly higher for tariff scores. If we think other companies like a consumer product, Church and Dwight, that's a company I owned for many years, and that has tariff score of 5. And all of this can be filtered because they are also added in the all-in-one screener. And they're also at all-in-one scoring. You can filter for companies with high moat score and companies with high tariff score. For example, how we added this. If you don't know where to find it, you can always search in the search box. For example, moat score. I just search moat here. Yeah, it's highlighted here. And I want company with at least 8, with a score of 8. For moat score, and also the tariff score. It's called actually tariff resilience score. I also want a company with tariff score of 8, and here, and you can see that the companies with the results are already here. And I can see Berkshire Hathaway here, Google, Meta, Amazon here, Visa, MasterCard are here. And we do list the exact reason why it's ranked this way at here. When, for example, Amazon has a moat score, very wide moat score of 9. It says Amazon has a dominant market position with strong network effect, significant customer loyalty, and economies of scale. So that's why it has a wide moat score. And also about tariff. Amazon's vast global supply chain and logistics network provides flexibility to mitigate the tariff impacts. Its strong pricing power and ability to shape suppliers enhances the resilience. So that's that you can read this and list the reasons. And I hope that it helps you. And I wonder, yeah, I'm asking why Berkshire is the only company with a moat score of 10. That's a very good question. Actually, I don't know either. It's we use the same rank algorithm, and Berkshire came out with the highest moat score, and I was wondering that too. But I don't think there's a huge difference between 10 and 9 in terms of moat scores. Berkshire also has a pretty good tariff score because we know that most of Berkshire businesses are in the US. Like the insurance business, they will not be affected much by the tariffs. And the Burlington Northern, the train business, maybe railroad business, maybe impacted by some, by the tariffs, and that's a case. And so that if you combine this with other ranks, like a profitability rank we have, and like the profitability rank or the growth rank, you'll get a small number of companies. You'll get a very small number of companies that, so we got 46 companies here. I want high rank for both profitability and growth. We got 46 companies. You can see that most are very familiar names, and they're good companies. They're all good companies. If I show you the chart, the chart, you can see that their business is yearly consistent, very consistent, and their profit margin are yearly high. And then you can see that the growth is also quite consistent in this case. That can be a very good list of stocks that you can invest if you want to invest in high quality companies. I can see Netflix here, and see that United Healthcare is also here. It has been beaten down lately, having the company has a very bad time last month. And but it's here. It's in the list. Maybe it's opportunity. This disclosure, I do own the stock in my fund. Okay, the FICO. Okay, it has some hard time recently also, but these companies are all good companies. Okay, I can take questions about moat score and the tariff score. And okay, let me look at the questions. Where do I go access moat score, tariff score on the platform? It's for every stock, and I think I showed. if I come to GuruFocus website, if you just enter any stocks here, for every stock, I just randomly choose here, Ford. And it's in the profitability rank box. It's here, Moat score and Tariff score. It's in the, at the bottom of the profitability rank. It's here. And we will add links to these scores to explain to you how they're ranked in details. So we're still in the process of adding it, so it's not released yet, but we'll have the page ready and it will be added. That's a very important feature. Okay, let me look at Hunter's question. I was wondering if there could be a feature add to the screener to allow for company listed on screen to be exported to a PDF rather than limit to market cap. So for the companies listed on the screener to be exported to a PDF rather than limited to market cap. I'm not sure what information you want to export to the PDF. For every company, we have a PDF file already. It's called Manual of Stocks. It's actually a very detailed PDF file. There's also a one-page file called Stock PDF. If you just click on that, I can show you an example here. Hunter, if you're not familiar with it, it should generate a PDF file. Maybe it's generating, or maybe it should. Somehow, yeah, it's here. No, yeah, it's here. Yes, it's here. It's a PDF file that's generated, and you can see that for every stock, it does generate a file, PDF file. There's also one-page file. It's called stock PDF. It's just one page. It makes it easier. It's okay. It's actually, yes, you can download it as one page, but when at the individual stock page, it's a 16-page document. It can be generated on the fly with the current information. So if you want all of them in one file from the screener, I think we do support that too. If you come to here and download, if you click on download, we have it somewhere we can download. Yeah, here currently can only be downloaded to Excel or CSV files. I think, okay. Let me look at other questions. Can you please also answer? I have questions regarding long-term mode for Airbnb and OLED. Okay, I'm in loss for these stocks. Okay, let me take a look. Airbnb and okay, the Moat 7, Tariff score 9. Oh, yeah, of course we can understand that the Moat Tariff Airbnb will not be affected by Tariff. And the Moat score 7, which is not bad. You said you're at loss with a stock. Yeah, the long-term performance of a stock is dependent on lots of things. A Moat is a requirement, but it doesn't guarantee that stock will do well after you buy it. There are lots of other factors. The growth, I think, is the most important factor. The profitability is growth and profitability. I think those are the two most important factors. If you look at the financials, Airbnb, yeah, revenue is growing, maybe it slowed down some, but the profitability seems to be not consistent. It did well after pandemic in 2023, but seems like the profitability, the profit is declining. I don't know the reason. You have to study it, but I think it can be the reason which for why the stock has not been doing really well. And also the valuation, initial valuation can be very high for this kind of stock. the expectation was high, so the initial valuation is high. Even at current valuation, the P is 33. And I would say it's at this kind of market, it's not that high, but it's not low either. The revenue growth is 21%, and the P ratio is 33. And we do rank the stock as slightly undervalued, modestly undervalued, and we all know what Airbnb does, but I'm not sure I understand the company really well. I never studied. I cannot help give you advice whether you should sell or buy, but you do need to study, and we do provide all the tools you need. Okay, and let me continue. I want a feature to add moat score to portfolio viewing page to check moat score. Oh yeah, I think it'll be available. It's not available yet. I'm not sure it is, but it'll be available. With the political economic turmoil or in Ukraine, Trump tariffs, is it time to consider taking position in gold or keeping some cash? If so, recommendation, please. Oh, I cannot give you recommendations, but I do own gold. I think I mentioned that before. I started to buy gold sometime last year or about more than a year ago. I think about the first buy was about a year ago. The main reason I bought gold was because I think the U.S. Has too much debt, and the debt is just impossible. Now today the debt is $36 trillion, and the interest payment on the debt is consuming about 20% of the government income, the tax income. So, and the debt is just growing much faster than the GDP. It's not sustainable. Warren Buffett mentioned this during the shareholder meeting also. The debt is just not sustainable. The debt is growing like 6% to 7%, 7% a year, but the GDP is only growing maybe 2 to 3% a year. That means the debt to GDP ratio will increase every year by 3%, 4%. And this is just unsustainable. And that's actually the only thing I worry about the US. That's the only thing I worry. I came to this country 25 years ago, and I love this country. Actually, more 27 years ago. And I love this country. I wanted it to do well. And all my family are here. My children are here. My parents are still in China. And I want to do well, but the debt is just worrying me so much. And I cannot do much to it. As an investor, I can only do something to protect myself. And I vote for, I do vote every time, every election, but it's just not helping. And I think that's my biggest worry. And that's also the reason I bought gold. Gold has been doing really well over the last 2 years. But the national debt is really makes me worry and I think about it all the time. It's actually more than anything else, I think, for the country. And it will be a big crisis if this continues. I have no solution. I have no solution for the country. Okay, that's my just some of my opinion. Okay, let me see more questions. Could you please show quick backtesting function? Yeah, let me go. Some Folio is asking backtesting. Yes, let me go back to the screener, and I have not finished what I want to introduce the new features. We added the moat score. We added tariff score. Another filter we added the geographic revenue. If you look at this one, and it shows you can filter by the company's revenue source, where it's from US, from Canada, from Europe, things like that. For example, I'm worried about the national debt. I want to diversify my investment into countries that, into the companies that's less relying on the US. Their products are mostly made in outside the US, for example, because I think the US dollar will go weak. And it helps if the companies produce most of their product outside the country. And I think. So then I just do this filter US, I have it less than 30%. I want the revenue source less than 30% produced in US. Then I got a list. I can see that the Broadcom, about 25% from US, and Tencent, it's a Chinese company, only 3.2% in US from the US. And MasterCard, about 30% revenue from the US. And Asmail, the UV light, the XUV light maker, 16% from the US. So that's a filter we added, and you can, of course, you can filter for companies that produces mostly from the US also. And if we do that, you can see that T-Mobile, of course, revenue mostly from US, United Healthcare, Wells Fargo, AT&T, Verizon, Progressive, Charles Schwab. Okay, these are the companies that have their most revenue from the US. And that's a filter we added. I think it can be useful if you want to diversify into certain regions of your investment. Those are 3 filters we added: the Moat score, the Tariff score, and the geographic revenue. I think it's really, they're really useful. Okay, now let's talk about backtesting. And backtesting, if I start over, backtesting, I'm not sure what specific questions you have, but let me show you how to do backtesting. And if I just come to a screener, one of my pre-existing screeners, like the high quality one, if I just select that one, the filter is set already here. It has financial strength requirement, profitability rank requirement, predictability, and ROE. It's my list of my filter to filter for companies I think that have higher quality. If I want to do backtesting, I just click on backtesting here, and I select a number of stocks. In this, if I select 20 stocks, then you need to select a rank. If I want to rank, select the rank, the return from return on equity and 10-year median, the largest or smallest for the last 3 years, and the rebalance, I want 12 months rebalance. So I just click on go, and it should just start to calculate for every 12 months. And yeah, you can see that 2022, then calculating 2023, it will go on. It will go on, and then after finish, it will show you the results. Yeah. And then it's calculating the performance, and for every performance chart. Yeah, you can see the performance here. You can see that the return is this chart, and and also the indexes are listed there. That's how you do backtesting. It's quite straightforward. There's some of the calculation of alpha, beta, Sharpe ratio here, and the combinations. You can adjust for the parameters based on my existing screeners. Can just click on one of them and select, and then you can modify on it. Okay, I hope that answers your questions. Okay, let me continue. Brainstorming. GF value growth score largely depend on analyst estimates. Yes. Are we supposed to disregard analyst estimates? I don't think so. I think overall analysts are doing a decent job. If you look at the estimates results, especially with revenue, they are actually doing a decent job. We have to have something to rely on, and analysts maybe not always accurate, but they are doing a decent job. But just look at forecast. We look at the track record here. In the case of Microsoft, and yeah, you can see that this is the revenue. The revenue and the surprise and the difference and the actual the difference actually just 1% or 1%, 2%, very small. But sometimes it does cause a large price change with the stocks because Wall Street is sensitive to it. It's too sensitive to it. But decent, they're doing a decent job, a few percent difference. Even with earnings, they have a few percent difference, especially the revenue. We actually rely much more on revenue than the earnings for the GF value chart. So the revenue, they're doing a decent job, pretty good job, I would say. Okay. CPRT has a okay, we have a guy from Russia. Okay, yeah, you're welcome. CPRT has a 100 GF score. Okay, I do own the stock just to close. Yeah, everything looks pretty good. I do invest quite a lot into the stocks that has high GF values, GF score, and the profitability rank and the momentum rank. And GuruFocus is the only tool I use to do research, and I heavily rely on it. So I believe it also. I believe in it also. That's why I own the. What's your opinion? Is it a perfect investment right now? I don't own stock. I don't know. I think I have if I don't own it, I think I will buy it. But I do own quite a bit of it. That's okay. I want to share my best stocks that I have 40% portfolio in it. GuruFocus scores help me help me find how good the company is. NVO, okay. I see it has a Moat score of 9. Yeah, the stock went down a lot. Went down a lot from the peak because the drug, the weight loss drug, it was not as good as others. Maybe the Lilly's with the market had some disappointment. Now it recovered some. I'm not sure your buying price, and wish you good luck on that. Okay, let's see the OLED. I'm not sure what this company, Universal Display. I'm not sure what this company does. Let's take a look. The company doing organic light emitting diode. Okay, I see. Technology from display for mobile phones. It's a new technology for sure. Organic diodes. And I personally don't like this kind of companies because technology is new. The technology is relatively new, and usually, and the company looks profitable. It has been profitable for some years, but recent growth has not been very good. Seems like I personally kind of don't like investing in companies with new technologies unless it's really proven. And although I have a technology background, I just am too much affected by Warren Buffett, I think, influenced by Warren Buffett. Okay. I think I explained backtesting already. DLM. Okay, Anthony. Any good streaming companies that you would suggest based on my model? I didn't invest in gold companies. I only invest in gold. But if you want to look at gold companies, gold mining companies, for example, gold streaming, and you can search for them. And you just click on gold. You just gold mining, for example. You just type gold mining here. Yeah, you'll get some companies that's related to gold, GFO. I think in this case, you probably need to look at their financial strength, look at their profitability rank, look at their growth rank, and also look at their moat score. I think usually they probably have good moat scores, good enough. And you want to invest in those with strong financial strengths and the relatively high profitability. I think those have higher chance if there's anything happens to gold prices. I don't know, but for this kind of company, usually because they usually have higher capital requirement, and you want to invest in company with strong financials. Okay. Chris, what's my view on AI impact on trading next years or two or in future? I think so far at this point, AI is being used extensively just for doing research, for summarizing a report, for example, for get the key information out of long text. For example, that's mostly also help us to search and summarize things online. It has been very convenient. But in terms of trading or investing, I think one of the most important things is the confidence. Is the level of confidence you have, no matter what you do. No matter you do it manually or you do it automatically with AI. And maybe some people will have strong confidence with their AI model, then let AI trade for them. Maybe some people will, but I think the key factor is the confidence, the level of confidence you have in the model, in the AI itself. And I personally think that it's hard for people to have enough confidence in their AI model to trade most of their money. I think it's hard to do. And everyone's just using an AI model that they have 100% confidence in and trading for themselves, and all the AI just competing to see who has the best AI and then who will win in the market. And I don't say that. I think it's still human confidence. Okay, data license for was Brian is talking about data license. No, actually, the price has been. It really always depends on how you use the data. Yeah, we did change the model. We got quite some requests. Yeah, it really depends on how you use the data. If you have specific questions, you can contact us offline. We'll certainly get back to you on that. Okay. In the warning sense, there's risk assessment. Should low risk, high risk? That's actually a good question. We brainstormers talking about risk assessment. We have in warning sense. Yeah, risk assessment. If we click on that, it explains to you how the risk assessment is done, and we do it based on certain factors such as the valuation and the quality, the fundamentals, and growth. All these we do this. So we use a matrix which considers all these factors and to assess the risk. If a company has low valuation, does not mean it has low risk. Although valuation is low, it doesn't mean the risk is low because the business can deteriorate from the past trend. And so that's the quality of the business. That's also related to the mode of business and also the fundamentals. The financial strengths, which we have observed lots of companies that was undervalued, but goes even more undervalued over time. It's actually a value trap. So we do consider all these factors, then we give a assessment. In CPRT, core parts case, the risk is low because of strong fundamentals and reasonable valuation. That's our opinion. Okay, Chris, Brian's asking, what's your opinion on the value metrics? It's value TD. Okay, TD. Okay, TD back. I think it's a TD. On the valuations of TD back. Let's take a look. Stock has been doing not that, yeah, this year it's doing okay. So pretty good, 31%. This year is pretty good. Over 10 years, it's 59%. It's just so. I think underperforms. Our valuation model think it's reasonable valued. I think it is. And the business growth has not been very fast, and now it's close to historical valuation, a middle range of historic valuation. I think, yeah, it's probably and reasonably valued. We don't expect lots of growth from the company probably in the future. Okay. Charles Barrs, okay, he said that on Moat and Tariff score, I don't see how these are closely related to profitability. Maybe this fits better under financial strength category. The Moat, in principle, the Moat is a guarantee for the profit margin. If a company has strong Moat, and it usually has a large profit margin, not 100% at Costco. It has strong Moat, but the profit margin is small. But that's because of Costco's business model. But usually, if you look at a company with a large, strong Moat, and the profit margin is usually high, let's do a filtering, and let's show the company with strong Moat, and also then I will also show their profit margin, the operating margin, like the 5-year operating median margin. And let's see, this is a company with strong Moat, and the margin. Let's see the margin. Somehow Berkshire margin shows a 5-year median is 0. Maybe Berkshire's because the calculation of investment is also in it. But if you look at the operating margin, mostly in like 20-something%, 40%, 20%, those are very high margins. These are really high margins. I just randomly show the company with strong Moat. And margin is usually the wall which protects the profitability of the company. So that's why I think it belongs to the profitability area. Okay. 52-week high low screener Victor. Okay. Yeah, we do have a 50-week high or low screener here, like here. It's under value screens, 50-week high, 3-year high. You can also go for 3-year high, I think. Okay. Stock at 50-week highs, stock at 50-week lows. Stock would have somewhere, yeah, 3-year high, 3-year high. 50-week, yes, 3-year high. Company has 3-year lows. You can filter for this, for those companies. And, but in my past observation, I found that many years of observation, yeah, initially when I got started with value investing, and it was popular to buy stocks at 52-week lows. It was popular at the time because value investors think that if a stock are at 52-week low, the valuation will be low, tend to be low, which is true. But over the years, I have observed that quality and profitability are more important than prices, than stock prices, than the valuation, than stock valuation. And you don't want to buy stocks that are extremely overvalued. But if it's reasonable valued or even slightly overvalued, if the company is extremely profitable, profitability is high, and the growth is good, it's better to buy those companies than buy a company that does not grow, but at 52-week low valuations. I think Peter Lynch said in his book, he said that he'd rather buy a company with a P ratio of 25 that grows at 25% a year than company which traded at P ratio of 10 and grow at 10% a year. Something like that. So growth and profitability, I think, are more important than valuation. That's why I always put more effort in studying the quality of the business than the valuation of business these days. And if you have not read my book is called Invest Like a Guru. And actually, if you want to summarize the book, it's actually just one sentence. Buy good companies only. Just buy good companies. Don't buy others. I hope that you agree. Okay. Rick, what's the difference in criteria for stock that's significantly undervalued and the one that's undervalued but also listed as possible value trap? Okay, that's a good question. I mentioned it slightly before. A company undervalued, of course, we love to, if a company is undervalued, but the quality is good. But the market is actually quite efficient most of the times. If a company is extremely undervalued, that there's usually a good reason for it. And we can screen for those. We can GF valuation, significantly undervalued, and also possible value trap. We can screen for those. Okay, let's just randomly select one, FMX. I'll give you an example why we think that company is a value trap. Value trap, by definition, it's usually undervalued. Okay, this is maybe not a very good example. I think we had some problems that we have not fixed. Christian. Okay, yeah, the company is undervalued, certainly is undervalued. But we usually not just look at valuation, we also look at the few factors like the Petrosky F score, the Altman Z score, and the Benish M score. We also look at the growth of the business. In this company, the business, in this kind of Christian Dior, the case, and the Altman Z score is not so good. Altman Z score of 1.79, and it means the company is in the kind of financial distress situation. And that's why we warn you it's a value trap. It can be a value trap. So you do need to study the company's financial very carefully, and in this case, although it's undervalued, but the financials is distressed. And in the past, I have observed this many times. I remember for a long time we have listed like the what's kind of BlackBerry. BlackBerry was as a value trap. The reason was that the company growth is just gone, and we list it as a value trap. As a valuation is really cheap, not just us. Lots of famous investors fell into the trap. Especially like I remember Francis Chu, the Canadian investor, and also Prem Vasa, the Fairfax CEO investor. They're both great investors. They're value investors. They're deep value investors. So they fall into the value trap of BlackBerry because they think that if you just sell the patent of BlackBerry, it's worth much more than the market cap at the time. And yeah, the series thing looks convincing, but it just didn't work out. A value trap. It just lost its growth. It lost the past economic mode it had. So you don't want to invest in those. We provide a warning there, and if you really love the company, you think we are wrong, it's okay. You can study. We do want you to study there. Okay, how would I look like a company like SLB Schlumberger? It's oil equipment company, and the stock has not been doing well last 10 years. Over the last 10 years, the stock lost 63%. That's terrible. You don't want to invest in those kind of companies that the stock lost 60% in 10 years. It had its growth, but the last 10 years has been doing poorly. Valuation is low. Profitability is not low. In this kind of company, for this kind of company, you do need to study the financials carefully, the growth. You do need to study that. That's actually important, extremely important in this case. If you look at the growth, the company has not been growing. The revenue per share, it has been declining. And it has been declining. Will it turn around and grow again? I don't know, but I think it's hard. It's a hard question. Warren Buffett famously said that a turnaround never turn around. A turnaround never turn around. So, I wouldn't invest in it. Okay. Michael Cox has the same question as Rick. I think I answered that question. Okay, brainstorm. You say in your book, you're leaning to invest in mature companies and stay away from tech companies. Have you changed your mind? No, actually, I got even more convinced on that. Doesn't mean that I don't invest in technology companies. I own Microsoft. It's one of my largest positions. I do consider the economic moat there. I think in last meeting, people asked me, someone asked me about the Magnificent Seven, which one has the strongest moat? I answered Microsoft. I do invest in Microsoft. It's a technology company, but I think the economic moat that Microsoft has is just so wide that it's just very hard, almost impossible for someone to replace Microsoft. Even if you have $1 trillion, I don't know. I just see a possibility is so much less. Okay, Anthony talk about BlackBerry. It's now a pure software company for automotive business. I don't know that. I don't know. I didn't follow that anymore. I just thought that it's very bad investment, although it was invested by people like Prime Vasa. Prime Vasa had an amazing track record. Just look at here. That's a price chart for BlackBerry, and we have now we warned you. It's a value trap. Long before that much decline, and also I actually mentioned in my book also. It was 2016. Also Sears Holdings. It's history, but Sears Holdings. We warned you. We warned the investor. It's a value trap, but people like Eddie Lambert was investing in it, and people like not only Eddie Lambert, also Bruce Berkowitz. Bruce Berkowitz, the Morningstar fund manager of the decade. He was investing in it. And yeah, I think it was 2011. His fund was 21 billion, Fairholme fund. But he was investing in those companies, which we couldn't agree. Fairholme fund. Yeah, Bruce Berkowitz. And today his fund is 1.2 billion. It was at least 22 billion in 2011. So now it's less than a fraction, just a fraction of it. Unfortunately, yeah, that's the history of the fund size. Okay, so avoid value traps, and invest in high qualities. High quality will help you avoid lots of mistakes. Charlie Munger said something similar. I don't remember exact words. Charlie Munger said that something I forgot, but I said something. I said per company is like a marriage without love, and it won't. It just have lots of troubles. It will have lots of troubles. Okay, a Moat score of NVIDIA, and I think it must be pretty high. If you think it's just so hard to, yeah, it's 9. It's just so hard to copy that. What's your position on NVIDIA compared with Microsoft? Microsoft is I have a far more bigger position in Microsoft than NVIDIA. Okay, and then, how Joshua is asking, how would I take a look at FSLR? First Solar. Okay, it's a solar company. And I don't like this company. The company is already, I just don't like it. The stocks, okay, last 10 years, doing pretty well, 200% something. And this year, not so good. Stock, okay, we said it's value trap. Few reasons, because first reason I think is it can be a manipulator. It's Beneath M-score calculation. I found that there's maybe some tricky accounting with it. The Petrosky F-score is not that good either. It's a 4. So the company is probably not doing as well as it was. If you look at the financials, okay, the revenue does not grow much. Profitability is not so predictable. So that's probably why. And we don't like these kind of companies. Okay, I think we are running out of time. And thank you all for coming very much. Thank you all very much for coming and coming to the meeting. And the next meeting will be July 2nd of this year, July 2nd. Same time, always 1 p.m. at Central Time. Hope to see you again next time. I'd love to see you again next time. Thank you all very much for all the questions. Sorry for the technical problem we had at the beginning. I think it'll be smooth next time. Thank you all for coming, and see you next time.